Good afternoon, everybody. Hope you had a good lunch. If you're in the Midwest, hopefully you're being very careful with the shoveling today. Yes, we got about 8, 9 inches here where I live. My son is outside shoveling as we speak, and it's driving my dog a little bit crazy. So you may hear some dog crying going on through the session today. I apologize about that. Um, Good to see everybody. I love the fact that you tell me where you are, and we got Eddie and John here today. We got Holden here as well. Jack is out today, so how's it going, guys?
Hey,
You
pretty
got
good. Thanks, Hogue.
you got snow? I'm sorry, John. Did you get snow?
Oh yeah, we got 9 inches here.
Okay.
Did you?
I think of it as love. We got a lot of love all on my sidewalk. So
Well, I hope you love that love for a long time.
Yeah.
It's going to be here.
Send your son over. I'll pay him well.
Well, today is the second to last session. I had up here the business plan, and then we were going to do context, hypothesis, and planning tomorrow. Doesn't really matter. We're kind of in the trading plan part of the program here, and we're going to take a look at everybody. I think has their own way, really, of putting context over the marketplace. The important part to me has always been the consistency, using the tools that speak to you and using them over and over again, becoming an expert with them, and then using that context to put forth your hypotheses as to what might happen and plan towards those hypotheses. So I guess we will get started unless you guys have something that you want to add.
Yeah, with Jack out, it's just going to be Eddie and I manning the chat and Q&A. So we'll try and get to everybody's questions. Apologies in advance if we miss a few along the way, but we'll do our best to address everything. Thanks, guys.
For duty and humanity.
All right, thanks, guys. And this one isn't quite as long as the one we had yesterday. That was probably the longest one. So maybe we'll have some time to work together on some of those questions at the end of the presentation today. All right. So again, that's me. February, 39 years in futures industry experience. Hard to believe. My dad was on the floor of the Board of Trade for 40 years, and we're going to get a visit from him tomorrow at the end of the presentation. He's got a lot of dad wisdoms that I use from time to time, and I think you'll hopefully find them both entertaining and helpful. I traded on the floor of the Chicago Mercantile Exchange for over 20 years, and had to migrate to screen trading like everybody has had to in futures. Stepped out of the pit in 2009 and hooked up with Topstep in 2011. As I met Eddie and Michael and found out what they were doing and really had to be a part of it. Eddie and I have been with Topstep since pretty much the beginning, and I know Eddie enjoys it. I enjoy talking to traders. We've had the opportunity to talk to thousands of them from around the world in helping them try to become better traders. So today, again, we're going to be talking about context and planning. Now, there are no holy grails. If I had a rule-based strategy that I knew would make money over time, and I handed that strategy out to 100 people, there would be 100 different outcomes. People perceive information through their filter, which adds at the very least their experience, motivation, fears, emotion, and psychology. Being honest and diligent in the work you do and in the review of your performance is the path to growth. One of the things that we haven't really touched on in these sessions, and we're going to probably look at this is in future sessions, is the review, the journal. The journal is more than just a trade log of the trades you took. It encompasses the mental, physical, and emotional changes that occurred during trades. This will be something for, again, for a future presentation. But the holy grail thing, it doesn't exist. It's all in your context and in your planning. Choosing the lens you're going to use and use consistently is extremely important. I've mentioned a couple of times, I think, that when people ask me how do I become a consistent and profitable trader, the first thing I ask is, what are you bringing consistently to the table? And that should be your tools for context. This is a quote from me, and this was something I was writing to an email to a coaching client, and it just rang so true that I continue to use it. And there is it's a deep symbiotic union, including self-understanding, market knowledge, and creative application of multiple market state-based strategies is necessary for lasting profitability. If you're quantifying strategies, your strategy may work for a while, but it's not going to work forever. You're going to have to be flexible and creative in moving forward with any strategy. Anytime the market state changes, anytime there's an expansion of the markets or a contraction of the market, things are going to have to change with your strategy. It's one of the things that I think makes humans poor traders or good traders. The ability to recognize the market state changing. Remember, it's creative application of multiple market state-based strategies. So when the market expands, you're changing your trading plan because the context or the lens that you're using over the marketplace is telling you there's a change in the marketplace. Problem is, as humans, we get too roped in on the patterns and the strategies that we've seen in recent history, and we can't let them go. So if something works, we want to go to it every time we see it, and the market is going to change the questions once you get the right answer. 1 + 1 rarely equals 2. 1 + 1 rarely equals 2. And once you do get the right answer, the market's going to change the questions. What is context anyway? The definition of context is the circumstances that form the setting for an event, a statement, or an idea, and in terms which can be fully understood and addressed. Can a market ever truly be fully understood or assessed? Everything is in context, probability, and what's the word I'm looking for? Hypothesis. Sorry, there was some ruckus over here going, and it broke my concentration. So forgive me on that. The thing that's important here in this definition of context is you are looking to put things in terms which can be fully or at least partially understood and assessed. Planning, context, understanding and assessing the current situation according to the things that you're seeing from the lens that you're using. My lens, market profile. In a 30-minute chart, very, very few indicators, nothing really all that complicated. You've kind of gone through many of the things that I look for in my ability to put an accurate context over the marketplace is all over these presentations. It's the auction process, it's volume, it's open interest, it's delta, it's market profile, it's the 30-minute chart. And we're going to take a look at the end of today's session, basically right out of my playbook, right out of the homework outline that I use. Okay. What is the bigger picture? What is the market saying? The market is full of information and is actively showing us and telling us what it is attempting to do. We're going to be using a top-down analysis. We're going to start with the monthly chart. Is there a trend? The monthly chart is there range bound activity in the monthly chart? Then down to the weekly chart. Is the weekly chart congruent or incongruent with the monthly chart? Is there a potential change coming? Then to the daily chart. We got the daily chart. Is it showing range bound activity, or is it showing continuation in one direction or another? You can even look into shorter time frames, but when we're looking at overall market context, starting with the top down is a good way to be able to recognize, even before the market gives us that hint in shorter time frames, that a larger time frame context or situation may be brewing, if you will. A strong trend on a monthly chart is going to take a long time to change. A weekly chart, it's going to take a long time for a market state to change on a weekly chart. You may see it beginning to be, you may see a change in the market becoming apparent on the daily chart that moves into the weekly chart and then into the monthly chart. So we're looking top down and bottom up sometimes. Remember, what is the market attempting to do, if anything? What direction is it attempting to go, if anywhere? And how good of a job is it doing getting there? There it is. I got a little bit ahead of myself, but that's really what context is all about, is making an assumption, a hypothesis, an educated guess as to what the market is attempting to do, if anything, and how good of a job is it doing getting there. Think back to the auction process. Think back to the things that we've been looking at day over day in these sessions that I have found are part of my lens. I suggest whatever lens you're using, whether it's a daily chart, whether it's a 30-minute chart, whether it's a 5-minute chart, be thinking of the market in the context of what it is. It is an auction. And what are the parts of the auction process? There's volume, there's open interest, there's time, there's value and price, which are not the same. And is the market in a trend or in a balance? What direction is the market attempting to go? And if anything, and how good of a job is it doing going in that direction? Your consistent lens is probably a series or a couple of indicators and tools. The chart type that you're looking, I look at two different chart types. There's the market profile / volume profile, and the candlestick charts in multiple time frames: monthly, daily, weekly, monthly, weekly, daily, 30-minute chart. That's really it. I look at technical information from the charts. I look at sometimes even candlestick information from the charts. Yet another class we're going to be developing for you is candlestick trading. But most of the context I'm taking is from the market profile, the volume, the open interest, thinking about the state that the market's in. Is it range bound or is it directional? If it's range bound, then I have a strategy for that. If it's directional, I have a strategy for that. If it's directional and getting stale in that direction, I'm going to be starting to have a strategy for that as well. So what I'm asking you to do, whether you're new at this or whether you're a professional at this, you've probably been tempted to drift, to go, well, this chart, doesn't work anymore. So I'm going to go to this chart, or this indicator doesn't work anymore. So I'm going to go to this indicator. I learned a little bit about market profile, but I don't really get it. So I'm not going to look at it again. I don't see how it's going to help. That's okay. But find the tools and the charts that are speaking to you and learn to become an expert in them. Whether you're, engaged in the markets for an hour a day or 8 hours a day, be consistent in the tools that you're using. Going from a time-based chart to a tick chart, back to a time-based chart, to a different type of chart, to Rankos, to all of it just lends to bring that inconsistency that you're trying to get away from. Think about the tools that speak to you. Become an expert in the tools that speak to you. If you want consistency, bring consistency. So the hypothesis is the basis of strategy. If you have a hypothesis that the S&Ps are going to, and this is the 2nd of February, we've had 3-4 straight days of upward activity in our equities. And if your hypothesis is, I don't see any reason why the market is not doing well on this upside move, that's part of your hypothesis. Okay, that's part of your context. The market is moving in the upward direction, and if I don't see any reason where the market is showing me that it is tiring in that direction, that part of my strategy is going to be, I'm going to look for opportunities to buy this market and on weakness. When it pulls back, I'm going to try and buy those pullbacks. It's given us decent pullbacks every day this week so far, but the market is ambiguous. It's an enigma, and that enigma comes from, I asked a whole bunch of people in the office that were non-traders, if they had one word, what would be the word they would use to describe markets? I was thinking somebody was going to probably come up with paradox, because there's a lot of paradoxes in trading. Things that we think are going to be true, the opposite is. That's the paradoxes. A girl in our office, Ali, came up with enigma. And I think enigma is a great word for it, because an enigma is a puzzle you can never solve, but it doesn't mean you can't profit from a puzzle that you can never solve. It is ambiguous. We do not know what is going to happen on any given day. We can say we know, and we might be right that day, but the market is always going to do what the market does. We have no control over that. So you really want to start preparing yourself to respond to different market situations, sometimes even in the same day. Even in the same day. Think how this will help with any biases that you might have as far as the market state, market direction. We talked about the cardinal rules of trading a couple of weeks ago. One of the cardinal rules of trading is the price can do anything. We can't control it. Stood next to a lot of guys who said this thing just has to go higher today, and watch them, pretty much lose accounts as the market continued to push lower. So having a plan for different situations, if the market changes, if the market does this, then this is the strategy I'm going to use. Now, we talked about market profile yesterday. The earlier you can anticipate the day type that you're going to end up at the end of the day, the better off you're going to be. But you have to try and anticipate the day type. when that day type hypothesis is coming true, you trade to that hypothesis. Market states. What is the current market state? If the market state's directional, say to the downside, I'm going to be selling pullbacks. I'm going to be selling when the market is exhibiting strength. And then being able to recognize potential changes in the marketplace. And how do we do that? Well, if we're range bound and we break out of a range, that's going to change the strategy. In a range bound market, we're going to be fading the extremes. In other words, selling near the high and buying near the low until proven wrong. A breakout proves that wrong. A breakout has us go with the breakout, and understanding what acceptance means when there's a new auction that is just beginning can help us deal with those potential changes without stripping our gears or killing our account. That is one of the biggest issues, is when there's a change in the market state. When the market changes, our inability to adapt quickly is what creates a lot of issues, a lot of pain. And it's not easy. Anticipate changes, to anticipate market state changes, to anticipate day types is something that takes many years. I've been at this for a long time. I still learn every day about getting better at anticipating day types, at getting better at recognizing context, and then putting forth my hypotheses and trading to those hypotheses. Now, you want to be able to nimbly adjust to market generated information. Market generated information is what Market Profile provides for you. We do see market generated information on any chart. It's the way the Market Profile organizes it speaks to me. It is my lens. It is the lens that I've chosen that spoke to me right from the very beginning. And it has been a lifelong study to try and get better at reading the profiles. There's a lot of nuances. There's nuances that are telling us the market could go higher. There's nuances that tell us the market could go lower. What's most important in the current context? So when you're thinking, then you're sitting down and you're doing your homework at the end of the day, at Sunday night, or Monday morning, whenever you do your homework, find a way to do that homework consistently. And I'm going to suggest some ideas for you. Okay. Here's a very basic hypothesis. When we look at this market, obviously, this market is moving higher over time. It's moving higher, we're getting pullback. We're moving higher, we're on pullbacks. We're moving higher, we get a pullback. We move higher, we get a pullback. Does it matter if this is a daily chart, or if this were a 30-minute chart? The daily chart is going to take a lot more time to change, but it's giving us the same information. This is potentially a healthy market. Okay, now there's things in here that we might say could bring a move in the opposite direction in short time frame here. More on those later. Okay. This is an uptrend. Okay. On an uptrend, what are we thinking as far as our hypothesis is concerned? We're going to look to buy weakness. As long as the market state doesn't change, when we find pullbacks where the market looks weak, that's where we need to buy it. It's hard. It's not easy. Another pullback here. We buy weakness. Sometimes moving averages in this regard can offer some degree of risk management. Where does the market state change? How far off the high do we have to have price come before we see a true market state change? Where is that level? Find your level where you say the market state changes. If we're going to be taking trades in the opposite direction, we want those trades to be fast, In other words, we sell a high and we make some money on it. Take the money. Don't fall in love with contrary trades. Longs offer the bigger opportunities, focusing on buying lower extremes, pullbacks. You know, if we were long here, this was a big trade. If we were short here, this was a fast trade. If we stuck with that too long, wasn't long before we were losing money on it. When the market is directional to the upside, longs offer the bigger opportunities. Focus on buying pullbacks. Okay. Very basic hypothesis number 2. Okay. Well, how can we tell when the auction might be tired in a chart like this? Well, there's a couple of things. The market's moving higher. The areas of balance start to overlap. Okay. So we have the areas of balance overlapping. We get a pullback. We continue the move to the upside. We stumble a little bit. We continue. We're still overlapping our balance areas. That can be indicative of a market that is tiring in that direction. We get some new life. We start to balance here. The balance here is overlapping, and we've got a key reversal pattern here right at the top, which is a bearish engulfing pattern. We had bearish engulfing patterns here. We had bearish engulfing pattern here. We had a bearish engulfing pattern here. These engulfing patterns are reversal patterns. Here's another one. Here's a bullish engulfing pattern right on the low here. Here's a bullish piercing pattern right on the low here. Okay, you can use short time frame levels along longer time frame levels. Some of these, if this is a daily chart, these swing lows offer potential opportunity if price comes back to them. In range bound activity, we find that the shorter time frame levels have a tendency to be respected. Okay. When we see that the market may be tiring in the upside momentum, we're going to start to perhaps focus on the upper and lower extremes. Not only are we going to be looking for opportunities on pullbacks, now we're going to start looking for opportunities on highs. So that's another basic hypothesis of the same chart. Uptrend, bearish engulfing pattern. What's going to happen here? We don't know. Okay. Planning. This is not your business plan. I probably should have put there. This is your plan for the day. Okay. This is how you're going to put together a suggestion for how to put together the information that we have. Okay. The context. What is the market attempting to do, and how good of a job is it doing getting there? The hypothesis. What do I see as high probability scenarios? And then planning. When one of those hypotheses or high probability scenarios comes true, what am I going to do to recognize when that hypothesis is coming true? And what am I going to do about it? So this is a outline loosely created around the outline that I look at and the research that I do. This is per product. Okay. So on Sunday night, I sit down and I open up the long-term charts, the monthly chart, the weekly chart. Notice any long-term directional performance. On those longer time frame charts, I'm looking for reachable visuals. Longer term highs and lows are a good start to look for reachable visuals. If there's no longer term highs or lows, swing highs or lows in the past, you're not going to be able to find them. Information. Okay, then I'm going to go down and I'm going to review the daily charts, looking for directional performance. Your indicators or tools showing continuation, ranging, overbought, oversold, the indicators and tools that you might be using. When I'm looking at directional performance, I'm looking at the longer time frame. I'm looking at areas of balance that are coming close together. I'm looking for evidence that momentum in directional markets is starting to fall off on the monthly, weekly, and the daily chart. I'm looking for, how is volume maintaining in this move? How is open interest? Is open interest starting to fall off in this direction, or does it look like we're still bringing money into the market in this direction? Okay. If the market's directional, again, we're looking for areas of balance that are far apart. Okay. Areas of balance in directional markets that are far apart are showing confidence in that direction. As those areas of balance get closer and closer together, the market is perhaps getting closer and closer to, number one, falling into consolidation, or number two, coming into an area of retracement. The market may have to come back off. We see this in the equities now. We came off the S&P's 10%, NASDAQ 15%. That was enough to even inventory or even get traders too short, and we see the market continuing to try and push to the upside. That makes sense. Okay. So those directional moments, directional performance, again, is volume sustaining price movement, is open interest sustaining price movement, are areas of balance getting closer together. You may think that, a slow stochastic on the daily chart, you may at this point recognize that the market's putting in higher highs, but the stochastic has a divergence. It's not putting up higher highs. There's another sign that the momentum may be falling off in that direction. These are tools that you can use. I'm using tools that I look at: volume, open interest, market profile, the day types of market profile, the nuances of market profile. And sometimes the talking heads on TV, because they're usually picking the high or selling the low, buying the high and selling the low. If the market is range bound, are there defined levels of extremes present on the daily chart? On the daily chart, in the profiles, is there a structural bias? Okay, are we buying weakness or are we selling strength? You might be looking at what kind of structural bias are we looking at? Well, in gold, as we speak, we have a bear flag forming. Okay, so that bear flag is basically a channel in the opposite direction, but the extremes of that channel offer opportunities until we break out of that channel. The structural bias would be, because the channel is moving up, the opportunities for longs inside that channel may be actually worth more than the opportunities for shorts inside that channel. Even though that's a bearish formation, if we don't break out the low, there's more space to the upside in a bear flag. Some people think I'm a little crazy. Are there any other tools or indicators to review? Review and digest and collect all the thoughts of all the information that you just went through. It's typically going to be a lot of information, and a lot of folks say, this is too much for me. This, you said to keep it simple. But again, doing this consistently will help you develop the mind muscles, the muscle memory, so that it's not so daunting. We talked about driving the car. You don't know what you're doing the first time you're behind the wheel of a car, so you have to think everything through, everything you do. But as you get used to driving a car, I always say we could drive to California tomorrow and really not think much about what it takes to drive the car. It's secondary functions. The secondary functions come in when you do something over and over again. You put together your 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 outline like this, and if something is not working, something you need to add something, there's nothing finite about any of this. The point being is you want to do it and you want to make subtle changes. You don't want to say, well, this outline sucks because I'm losing money. Well, there's a reason. Find out the reason why you're losing money. It's probably not the outline. There's something that you're missing. Find it. Okay. Any other tools or indicators to review? Okay. Profiles. If you're not a profile person, maybe start looking into it. Other time frame charts. Maybe you're a top-down guy going monthly, weekly, daily, 4-hour, hourly, down to a 5-minute chart. 5-minute charts give me heart palpitations. But with all of this information that you're currently digesting, give yourself 3 defined hypotheses. You're looking at the market, it's been moving higher, you're seeing signs of potential tiring of the upside auction. What are you going to do if that upside auction starts to break to the downside? What are you going to do if new business comes in and restarts that upside auction in a healthy way? What are you going to do if the market opens with a gap lower and closes the gap? There's all kinds of things that can happen, and if you're prepared for them with your hypotheses and you have a strategy that goes along with that hypothesis, you're going to be prepared. You're going to be able to respond faster using cognitive decision making instead of fear-based reaction. And it's going to hopefully make a difference right away. But if it doesn't make a difference right away, keep working at it. This is a living, breathing document. Okay, now we're at pre-session. We did our homework Sunday night. We did our homework last night. Now we're sitting down pre-session. What else are we looking at? What happened overnight? Do we have any economic releases? Do we have any economic releases? We better know when they are. Our good friend Jim Dalton says he doesn't think about the outcomes of the economic releases. He just wants to know when they happen because he believes he can see in the market information the outcomes of these releases. What happened in the overnight session? If you're trading the day session, if you're trading the night session, what happened in the day session? How does that affect our opportunities today? Or any important inflection points within reach from your longer term view, for perhaps? What about overnight inventory? Where is settlement? Where's the overnight high and low? Where's the 50% level? Review and update your hypotheses before they open because things may have changed. Okay. On the open, where is the market opening with regards to the previous day's regular trading hour range? Is it inside? Is it outside? Is it outside value, but inside range? Is there a gap? Does the market open outside of the previous day's regular trading hour range? Is the opening range, which we know is the first minute of trade in the regular trading hours, is the opening range left at an extreme? Is there any notable confidence in the market on the open? Is one of your hypotheses coming true? The market opens, it opens with a gap to the upside. We know there's overnight inventory that's holding long positions. Part of our hypothesis is if we leave the opening range at the high, that's an opportunity for us to bring price back towards settlement to close the gap. This is one of my hypotheses. If that happens, I know what to do. I'm planned for it. And then don't forget, of course, to trade what you see. What does that mean? People say trade what you see. Well, I'm seeing charts, I'm seeing markets. What do you mean trade what I see? There's always information that is going to end up being contrary to what we think and what we see in the markets. Sometimes that contrary information is extremely important. And it seems the more important contrary information, the more likely it's going to be a quiet talk instead of yelling like, hey, this is good, this is not going to work. It's like, okay, this is happening. What does it mean? As a human being, it's extremely important. It's important. It's extremely easy for us to discount information we disagree with in markets and in life. But those nuances, those things that change, can be helpful in creating a better outcome for ourselves. Take this information and make it yours. This is just part of the homework that I do every day. Okay. This is just a start. Again, nothing is set in stone. You're going to have the opportunity to make this better and better and work more and more for you over time as you learn more about the markets, you learn more about the charts, you learn more about volume, open interest, auction theory. There's nothing set in stone. You may find that the tools you're looking at as an early trader 10 years from now may be considerably different, but you're not going to get there in one fell swoop. It takes time. It takes subtle changes over a long period of time, baby steps. We all want consistency. This is your opportunity to really sit down and think about your outline, how you're going to be able to put context over the market using a consistent lens with a system to do so. When you do that, you're going to get really solid information to review. And that review is important to be honest about. Be thinking, okay, this review is, sometimes it's painful. We missed something. It's painful to review that, to learn from it. There's systems and there's ways to do that. And we're going to be adding a whole bunch of more content for you to get closer to yourself as a trader. So you want consistency, create a plan to bring consistency to the marketplace. Each of us is unique in motivation, opinion, risk tolerance, emotion, stamina, humility, creativity, discipline, wanderlust, flexibility, ability, fear, skill, knowledge, self-knowledge, and desire, just to name a few. We are all a beautiful mess. Okay, I believe a whole lot more traders could have much bigger degrees of success if they allowed themselves to that success. Sometimes they run out of time. Sometimes they run out of money. Sometimes they just don't want the change. Change is very difficult. Most people will do anything they can to avoid change. But succeeding at this means change. Trading is change. Prices change, markets change, market states change. Auctions change. Everything changes. Embrace it. Need, want, be the change. Kind of cliche there, but again, one last time, a deep symbiotic union, including self-understanding, market knowledge, and creative application of multiple market state-based strategies is necessary for lasting profitability. Each of us, again, is a great, big, beautiful mess. Success is not a straight line. It is a roller coaster. It is up, down, all around. To be successful at this, it's going to take a rewiring of your brain to some level, to some degree. Most of us face wiring that is contrary to being successful at this. Make sure you prepare. Learn how to take a loss. By learning how to take a loss and preparing, you're going to be hopefully able to maintain that account for a long period of time. And in that, you're buying the time to recognize to potentially recognize or have a greater ability to recognize when the bigger opportunities are there. Forget about perfection. There is no perfection. That's why I believe, I've worked with several, and I think mathematicians and engineers tend to have a hard time trading because there's no right answer. There is no perfection. 1 + 1 doesn't always equal 2. And you've got to enjoy this process. To me, one of the coolest things about trading is we don't know what's going to happen. When we can figure it out, when we can profit from something this ambiguous, the money's great. Of course, it's the process that feeds us, that gets us the money, that you really want to focus on. My good friend Steve, one of the best traders I ever knew, says he didn't focus on the money. He focused on learning to make good trading decisions. The money is a byproduct of being a good trader. Now, get out there and profit, trade well, and I'll see you in the pit. We do have one more day. Tomorrow, we're going to be talking about the business plan. This is your business. What if you had to put together a business plan and sell your business plan to somebody else? We'll talk about that tomorrow. Gentlemen, how are we doing?
Excellent, Hug. That was wonderful as always. Speaking of the pit, one of these questions that came in from DJ says, were you working for yourself on the floor of the exchange? Were most traders working for themselves on the floor?
At times, yes. And at
Directly,
times,
yeah.
no. I was a proprietary trader. There I was working for somebody else. I funded my own account. I was working for myself. I became a broker, but I was also an independent. So I had customers that were paying me to fill their orders. Does that count as working for yourself, or does that count as working for others? So there's all different ways to do this. A lot of folks had or made money. They never had to get money from anybody else to trade. The brokers were working for outside customers or customers on the floor, but they were also in a way independent.
Let me add there too. I mean, those that worked for themselves, I gave them a lot of respect. The locals, these were guys that had, 3 babies at home, mortgage, car payment, bills, food on the table, clothes to kids, schooling, and they were there every day. And it was just them. And I think tomorrow segue into the business plan, because these guys, these locals, were each their own little business, and it took a lot of work. And I tell you, a lot of those guys, you'd see them there every day putting in the work.
Yeah, it's Eddie. That reminds me of I went to the Mid-America Commodity Exchange. It was kind of a mini of the Board of Trade. The contract of grain over there was 1,000 bushels instead of 5,000 bushels like it was at the Board of Trade, and I had to find somebody to clear my trades. So I went to go see Ron Manister, who had Eagle Market Makers there. He backed and cleared a whole lot of local traders at the Board of Trade. And we sat down and he's like, so, you think you want to be a trader? Why do you want to be a trader? I said, well, because I just want to be able to like not come in one day if I don't want to, or work a half a day or come in late or whatever. He almost threw me out of his office, Eddie. He's like, do you think that's what this is? These are the hardest working people you're ever gonna know. Get out of my office.
They were. I agree, 100%.
Mm-hmm.
I
Excellent.
got
So,
Oh, go ahead.
oh, go ahead, Eddie.
I was going to
Finish
say, I
up.
got a question here from Juan over in chat. If my macro time frame is 1 hour, which would be the best to operate in the micros, 5 minute or 15 minute?
Well, I mean, without knowing you, if your longest time frame chart is an hourly chart, I think you're missing some information there. Look at the daily chart, see what the daily chart is saying, be paying attention to volume of interest. As for, your time frame, if your macro is an hourly, I'm not a fan of charts shorter than 15 minutes. I think that the 5 minute and the 1 minute exhibit a lot of trickery. I think that there's a lot of false opportunities that just show up, and I think that they lure traders into over trading. So, I would be thinking about, making sure I'm checking the daily, check your 1 hour chart, take a look at the 30-minute chart. You're going to trade less, but the trades you're going to hopefully be able to find are going to be worth more than the trades you're going to find on a 5 or a 10-minute chart.
Yeah, 100%. I mean, if you follow our weekly coaches playbook videos, we talk a whole lot about the top-down approach that you mentioned earlier. And I think it's a great benefit because it could stop you from doing something really, I guess, not beneficial to your bottom line. For example, you might see a trade setting up on a 15-minute chart, but if you widen out your lens to a 30-minute chart, an hour chart, or a 4-hour chart, you might find something completely out of line with that shorter time frame setup. I could share a workaround that for this that I do personally. If you have the capacity, maybe set up separate workspaces for every market that you're tracking. Have your quote board so you know what's moving or not. But I don't like to have a whole lot of charts up on my screens at one time. So if I'm looking at the ES market, I'll have 4 different time frames of the ES market up. I'll have my daily, a 4-hour, a 1 hour, a 30-minute, maybe a 15-minute or a 5-minute if I'm looking super micro. But that's just one way to maybe work around it. And we have another question coming in from Carl. When you are looking at the long-term chart and you notice the NY is going down, but after hours are pushing up, what do you take from that?
Longer term, I mean, if it's, to me, a long-term chart's daily and further away. If that's on a daily chart, it may not mean much. If we're looking at a 30-minute chart and the NASDAQ moves lower throughout the session, and in the overnight session kind of takes a move in the opposite direction, really the only thing that tells me is we have some shorter time frame, weaker hands longs buying into this market. We're going to have to see what happens on the open.
One thing, let me to add to those time frames too. I've talked to a lot of traders where it's a good analogy if you look at it this way. They're using the wrong time frames for the wrong markets. I had talked to some traders and a good handful where they're 1 minute, 5 minute on the NASDAQ. Now, I mean, something like that, if you can picture this, you go to an Indy race, Indy 500, you're sitting in the front row, okay? They make that first lap and they come around and it's zip, 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 zip. And you saw a blur, you're like, okay, well, they just went by. See, now, the thing is, think of yourself moving up in the grandstands and being able to see them coming around turn 4 into turn 1. So you've got to sort of figure out what market you're using. And that sort of goes hand in hand with time frames. Like, John, you like the 15, I like the 15. I think we've used that for years. It's a comfortable, and every once in a while, I'll look at, like you were talking about the context. I'll Google Earth. I think I mentioned this before. Let the market tell you the story. See what the market is doing. and like Google Earth, you do the monthly, the weekly, the hourly, and see what's going on.
Excellent.
Thank you, Eddie. I got my dog freaking out on me, so I'm muting.
Well, when you get when a quiet sound over there, Hogue, we got another one from DJ. Do you also take into account the weekly expected moves when planning to trade futures for the upcoming week?
What's an expected move?
That is a good question. Maybe if you could type in a little more context for that question, DJ.
Maybe that's the hypothesis, the educated guess. We're all trying to be fortune tellers.
There you go, right? Well, if that's your hypothesis, is that the market is going to be moving higher, throughout the week, you've got your plan kind of in front of you. You'll let the market open. You try and buy pullbacks when the market is exhibiting weakness, instead of, a lot of folks, I think, get roped into that fear of missing out, and the market's moving higher, and we're afraid we're going to miss the rest of the move, and we reach up and we buy it, and we put in the high, and then now we have to wait for the market to pull back, and we sit here and we take a whole bunch of heat and spend a whole lot of time worrying and before we even get to see and realize any kind of profit on the trade. But if we don't buy the high, we let the market come back down to us, buy it when it's exhibiting weakness, then we have the opportunity to try and find a cheap trade location in a market that you're hypothesizing is moving higher.
Thank you. We have another one from Anonymous here, wants you to walk us through a trade tied to your planning. So as we mentioned before, we're going to be expanding on some of these courses, technical analysis and market profile. So in the future, maybe we'll have more time and a chance to walk through some actual trades, but we've only got a few minutes left right now. So unfortunately, not something we're going to be able to get to immediately. But stay tuned for future sessions, future classes coming out, because we will be doing this type of thing in the future. Daniel asks, what is the best way to get my trading plan reviewed by someone who is sufficiently qualified? Maybe that's something you could bring up in group coaching later. Hogue, have you done that? Have you looked at people's trading plans and gone over them with them?
I have, but in personal coaching. So that's a kind of a one-on-one opportunity. If we were to do that for everybody, I'd be a busy guy. So it's a good question. I mean, if that's something that you would be willing to show everybody in group coaching, your plan, and we can take a look at it. Believe me, there's nothing wrong in a trading plan. It's just it's always going to be in constant improvement. So it wouldn't be like I would look at this and go, that's your plan. That's not going to happen. So if that would be something you would be willing to share with everybody, we could do that in group coaching.
Excellent. I'll throw the link for group coaching in the chat in just a minute also. We got another one from Andre coming in. Hogue, for how long does rollover activity distort volume and open interest in crude oil and equities? And how do you identify this phenomenon?
The equities, crude oil and natural gas roll every month. So you can pretty much count on an entire week. Sometimes it'll span a weekend where your longer time frame traders are more focused on getting a cheap rollover than worrying about directional activity. If you think about it, you've got 1,000 contracts of crude oil. That's what is that? 1 million barrels, and if you give up a dime for every 1 million barrels, you're giving up 100,000 just to roll your position over. That's why it's so important for the longer time frame to get a cheap rollover. Talking about rollover is a whole nother story, but that just takes a big part of the participants available to affect the market out of the marketplace. The market is a little thinner. It may go too far. It may not go far enough. Equities, it's every 3 months. We're going to be coming into rollover the beginning of March. It's the second Thursday. It's the second Thursday, unless the first day of the month is a Thursday. It's kind of goofy how they do that, but so that beginning of March, we're going to be coming into rollover. You're going to see a lot of the longer time frame participants more interested in getting a cheap rollover than becoming directional. So there's sometimes when the market will just kind of fall into range bound activity. I think that makes it the easiest for the longer time frame. They will be pushed into directional activity should something happen, but I think that their goal really is to make sure they get a cheap roll. So, your crude oil every month. Usually it's around the 18th when switch day is going to happen. So the few days up before the 18th, and 2 days after switch day, it's a little goofy. Equities, the second Thursday of the contract month. So March S&Ps, which we're trading right now, will roll into June, the second Thursday of March. It's a couple of weeks in the S&Ps because it's a much thicker product. It's the same thing in the treasuries. Treasuries roll usually about a week or two before equities. And we let you know if you're watching the forecast and the recap. We're going to let you know when these rollovers are coming in. Not for every product in the world, mostly just for the most popular products. But that's a great question.
It was a great answer. I think you'd be hard pressed to find a more detailed response than that. Thanks, Hogue.
My pleasure.
Next, from another anonymous attendee, do you have a fixed number of points you try to make on a trade? What is your usual stop, take profit size, if you wouldn't mind sharing?
Okay, so this is a really, really good and a really important question. There's a lot of traders out there that sit there. Well, they'll just say, all right, I'm going to trade the S&Ps and I only want to lose 200 a trade. Okay, so that means my stop is always going to be 4 points away, and I'm going to make 10 points on every trade I take. Well, if the market is volatile, 4 points may not be enough risk. You may die by 1,000 cuts. So if the market is expanding, you got to either be a better trade locator closer to point of invalidation, or you're going to have to expand that risk. Profit targets the same way. You may be in a market that's too small to get to your profit target. You got to be reasonable, probable with your profit targets, and your stops have to be placed technically, not financially, and not a static stop. You're always got to be thinking, okay, if I buy it here, where does the market tell me I'm wrong? What is the price that the market has to go to tell me I'm wrong? Not just $4, because that's all I want to lose on it. It's, where is the market? Where does price have to go to kind of eliminate that trade for viability? So if you're looking in a volatile period of time in the S&Ps, 8 to 10 points in a smaller market, sometimes I'll get away with 2-3 points, depending on how close I am to the point of invalidation for the trade. Point of invalidation is just another word for stop level. So, if you're going to have a static stop, when the market expands, you're going to die by 1,000 cuts. You're going to have to either be a much better trade locator and take that less risk, or learn to expand your risk a little bit. And I know it's hard, but if let's say you're trading 3 contracts in a market that is trading around 20 VIX. Okay, so we get an idea. All right, maybe we're going to be looking at 6 points of risk in the S&Ps on 3 contracts. If the market starts to expand, we may have to lower our trade size, because we may have to give that trade more room to stay in because of volatility, liquidity. All of those things have a factor in it. So the stop level for me is where does price go to disprove this hypothesis or this trade. And as far as profit targets are concerned, if I don't see a 2-to-1 reward over risk on any trade, I don't even bother taking it. And I'm really going to be looking for more than 2-to-1 reward over risk. But you have to be reasonable and probable with the trades. You know, you get a trade that's going 5-6 times risk, it's real easy to start getting dollar signs in your eyes to thinking, wow, this one's going to be a doozy. And you may, decide not to take your profit target, and that might end up being a mistake because the market might turn around and take half your profit away from you. Oh,
That's some truth right there. Here's one from owner. Do any of you use correlating markets like bonds or currencies as possible indicators, as opposed to other markets like ES, NQ, YM, etc.? Oh yeah. This is a super long form answer. I think we could really go down the rabbit hole with this one, but I'll refer you to our website, topstep.com. Just type into the search bar correlations. We have a lot of content around this, a couple blog articles. We've done quite a few videos on market correlations. So use those references for now. Maybe tomorrow, if we have some more time, we're going way over right now, but if we get some more time tomorrow, maybe we could answer a few more of these. And I think one last one from Sam wants to know, how long were your trades when you traded in the pit, and were they all intraday?
Intraday. Started out much shorter time frame. When I started learning the profile, my time frames got a lot longer. I was taking, looking to take much bigger bites out of the marketplace.
Excellent. And with that, I don't see much new coming in. I think we hit them all.
Awesome.
So with that, Hogue, you want to take us home and set us up for tomorrow?
Sure. Tomorrow, last day, I'm talking about the business plan. It's kind of similar today, but a little bit more 40,000 feet. If you were to create a business plan that you could sell to your wife or to a friend about your trading, how would you put it together? What would be in it? We'll take a look at that tomorrow. I feel like we should have a party for the last day. But unfortunately, we're not going to do that. Maybe next time. And we'll look forward to seeing you there. As always, gentlemen, Eddie, Holden, John, thanks for being here. Thanks for answering the questions. All of you, thanks for attending. And hopefully everything that we do is probably not going to help. But if you take something out of each of these classes to help you benefit your performance as a trader, then it's been worth it. We'll see you tomorrow.
Take care.